China exclui veículos elétricos do Plano Estratégico de 2026 a 2030.
China has signaled a major change in industrial policy by omitting electric vehicles from its strategic industry list for the 2026 to 2030 five-year plan. This formal exclusion was disclosed on October 29, 2025, and is widely interpreted as a signal that large-scale direct subsidies for the sector are likely to be scaled back. Beijing's decision follows more than a decade of generous state support that helped create the world's largest electric vehicle market. Policymakers and outside analysts say the removal reflects a belief that domestic manufacturers have strengthened sufficiently to rely more on market competition and less on broad fiscal incentives. The policy shift is being presented as a strategic reallocation of government support, rather than an abandonment of the sector. State support has been central to China's electric vehicle expansion. Over the past decade, national purchase subsidies, tax breaks, and local incentives helped manufacturers scale production, develop domestic supply chains, and drive costs down. That policy mix was reflected in earlier five-year plans that listed new energy vehicles as a strategic area for development. The export data underline how the industry has internationalized. In September 2025, exports of battery electric and plug-in hybrid vehicles rose sharply, doubling year-on-year to roughly 222,000 units. That surge highlights strong demand abroad, even as competition and margin pressure intensify inside China. The export rebound is a key factor in policymakers' calculation that the sector can increasingly compete without the same scale of direct consumer subsidies. The draft strategic blueprint for 2026 to 2030 does not list new energy vehicles among the priority industries that will receive top-line policy support. That formal omission reduces the likelihood of future large-scale direct subsidy programs aimed at consumer purchases or broad production support. Analysts say the move signals an intention to let markets play a larger role in deciding which firms succeed. Market data show Chinese manufacturers are already seeking growth beyond their home market. Reports point to a record month of Chinese car sales in Europe in October 2025, driven by strong demand for battery electric and hybrid models and led by firms such as BYD, SAIC's MG, and Chery. This overseas momentum is one reason firms can be expected to shift emphasis from domestic subsidy-driven volume to export growth and product differentiation. Industry commentators say the policy change could speed up consolidation. Companies that have depended heavily on subsidies may face margin pressure and restructuring. At the same time, better capitalized and more efficient manufacturers may accelerate investment in higher margin products, including premium battery models and hybrid variants, and in software and intelligent features. Observers note that targeted public support for charging infrastructure, standards, and research and development remains likely even as broad purchase subsidies are wound down. In the short term, firms that have depended on broad subsidies may see margins tighten, and some may restructure or exit. In the medium term, the industry is likely to shift toward export-led strategies and product differentiation, including a focus on higher-margin hybrids and premium battery electric vehicles. Consolidation and possible mergers and acquisitions are a plausible outcome as market forces reassert themselves. Responses to the policy pivot are mixed. Analysts and trade advisors describe the change as a market-oriented recognition of the sector's maturity. Some commentators caution that an abrupt withdrawal of support could harm smaller manufacturers that lack scale. Official commentary from Beijing has framed the change as strategic realignment rather than a sudden austerity measure, and government agencies are expected to pursue more targeted measures to guide the sector's development. The policy move coincides with strong export numbers and growing overseas sales, underscoring how quickly China's electric vehicle industry has internationalized. The exclusion of EVs from the 2026 to 2030 plan marks a turning point. Going forward, government action may shift from broad purchase subsidies to supporting enabling infrastructure, standards, and research and development. At the same time, companies must now demonstrate that they can sustain growth and profitability on commercial merits in increasingly competitive global markets.